All right. Welcome everybody one more time here to my YouTube channel. And today I have another, I would say, interesting topic for you guys. And in fact, you may have noticed by now that I'm doing things, I would say, very much differently than the average educator out there, than the average, definitely signal provider, than the average whoever pretends to be a trader out there, right? The reason I do that, or why I do it differently, is because I do not believe that I found the Holy Grail. I do not believe that there is a one single strategy or approach that will prevail, that will continue to work forever. Actually, on the contrary, I am very much convinced, and actually have been proven by life that this is true, that there isn't. No single one strategy stands the test of time forever. Every working strategy is always a work in progress. It's always something that you need to reassess, redefine, retest, reapply, in order to really, continue to be on the edge of it, like on the brink of the next development. Because you will notice things as you continuously analyze what you do, as you continuously pay attention to the changes, the data, how well it fits, and things of that nature. That's why I am not the Holy Grail guy, but I much more believe that your process, you doing these things, is the Holy Grail, basically. This is why I focus on strategy development. This is why I focus on the prime system. This is why I'm teaching this to my students, and this is also why we work, or I work with my students in a long-term, effort, really help them to develop the skills of strategy development. To come up with an idea, first of all, to validate or invalidate the idea from the data that you gather, and then also, create rules around it, make sure that you prove these rules actually work, and then, step by step, become more confident, train the execution of it, and become more capable, and at the end of the day, basically become able to trade successfully, plus to really continuously develop your trading strategy to a better and more state that actually is relevant to the market, with statistical proof of exactly these things, and that is why, and how did I come to that? Like, why do I see it this way? I've mentioned it before, and I'm gonna touch on that for a moment. I have literally analyzed thousands of trading strategies over the years. I have worked with many traders from all over the world. And I have failed with many traders over the world as well, especially in my very beginnings. And the point is that a lot of people that trade, or especially a lot of people that also teach trading, what I noticed is that they kind of approach a multi-dimensional challenge with a one-dimensional approach. Meaning, you only look for one pattern on a chart, or whatever it is, like most people really just put one angle, one dimension, one way of looking at things into their analysis. And then they just build a little bit of, risk reward around it. And that's kind of it, But what I came to realize, really after assessing and analyzing so many strategies, I needed to find a way that is more real, that actually captures the ability of a strategy to be successful a lot better, and actually allows me to qualify whether a strategy is rather good or not, because one thing you really need to understand is that you may also be lucky in a way. You may catch a pattern that works for some time, and then it suddenly stops working because the market changes, the volatility changes, the broker's execution changes. There's so many factors that could be a reason of why things change. But if you don't realize the change, and you, let's just say, religiously, blindly believe in your strategy only, then you will continue to trade it, hoping that at some point it's going to be profitable again. And before you know it, you're going to crash and burn again. So you can even crash and burn after having a working strategy. You can actually much more crash and burn after you have a working strategy, because you religiously, fanatically hold on to it without validating and invalidating it. It's just a belief, and that's really the problem. I don't believe my own thoughts. I need to prove my thoughts, whether they're true or not. By what? By data, and by acquiring data, and by looking at this multidimensional issue, what trading is, challenge, from a number of angles, to really consider a number of dimensions here that are at play. And I really think it's very important that we mention that, because, like I said, a lot of mentors out there, or a lot of sources of education for trading, they don't really touch on these things too much. Even when you have, let's just say, a pattern, like an idea of how you want to enter, like what are you looking for? It doesn't, it's not enough. You need to put it in more perspectives. And this is how I came up with what I call the 7 building blocks of every trading strategy, or of a trading strategy. It doesn't really matter. What I found out is that these pillars, these 7 dimensions to look at a trading strategy, help me massively to make sure whether the strategy really, how well it is defined, how well it is possible to reproduce a certain result, and also how quickly a strategy starts to maybe become different, so I can adapt to it, So that's very, very important that you understand that these building blocks that I came up with here, that we are teaching in my mentorship long-term in an individual work with you, one-on-one, that there's a reason for that. And that reason is really that after working with hundreds of traders, analyzing thousands of strategies, I found out that looking through the lenses of these 7 building blocks will give me a massive amount of advantage over not doing it. And this is why I'm very much, determined to share this with you. And in the coming videos, I probably will touch on each building block separately. And today I just want to go through the building blocks in a summary, in a quick summary here with you. So number 1 is market phase, because what is the market doing? Is it trending? Is it going sideways? Is it not so clear what the market is doing? Because that makes a big difference. If you don't pay attention to these things, then you're just following the trend. You may buy at an upper end of a trend, or you may sell at a lower end of a trend, and you may basically be caught. This is what the classical trap trader, basically what you will find in other literature and traders talk about. This is how it happens. So as you determine the market phase, and as you use certain tools to be able to determine the market phase in a relative fashion, not by absolute numbers, not by just by a number of pips, not just by, but by really, relative values. What is the volatility? What is the typical range? Where are we in that move? How extended are we? These kind of things really, really matter. So when you pay attention to the market phase, then you are much less likely to buy a top or to sell a bottom. So that's number 1. Number 2 is price location. So where within your channel or your range or in the market phase or whatever you're trying to trade, maybe you're trying to trade a sideways market, maybe you trade Asian scalping, whatever it is, where are you? Where's the price at the moment? What's the price location? You need to have clear methods to determine the location of the price, and you need to integrate that again overall with the rest of your trading strategy, because that can give you, also helps you a lot more to be confident about your trade. Because again, if you figure out a way that can give you more reliably information about where you are from a price location perspective in the big scheme of things, or within the range, or the whatever you want to trade, then that will help you again to not enter into trades that are at a not so well advantage. Actually the opposite. A lot of times we enter a price that is at a disadvantage to us if we don't consider the price location. So that's so important that you pay attention to price location and also come up with tools that help you to determine the price location. And again, to integrate that into the rest of your trading strategy. This is how you build what they call an edge. An edge in trading means just that you have a number of tools that you add together and that give you a statistical or a statistically relevant, enough of a reason to support that. At the end of the day, it's all theses. We all come up with hypotheses, ideas that we need to prove or need to disprove. And this is why we need to add more and more and more layers of ways to prove it or to figure out, oh, maybe this isn't just like that. But again, here, the price location is important that you understand that, again, we're not just talking about a certain absolute figure here, but we talk about ratios, relationships, and that will bring coherence into your analysis process, and it will give you confidence when you see a price where you see a trade opportunity where the price location also lines up nicely. It just increases your ability to score, and that's what we're looking here for, right? We can only manage the odds. We cannot control the market. We cannot impact the market. The only thing we can do is we can react to the market, and we can look for specific patterns that we have analyzed in the past through a number of perspectives. This is why I'm telling you the 7 building blocks thing. So that will give us a higher probability of success. Does this make sense? It should. If it doesn't, well then listen to my videos again and again. It will at some point, I promise you. Next building block is entry pattern, right? This is what usually people pay attention to only. A simple technical analysis pattern. But, just the entry pattern all by itself, if that really worked, then, this auto charters thing that every other broker basically sends out to its clients, it would work, Then why are they giving it to their clients for free? Because they're all making money with it? Well, okay, you answer that question for yourself, but the thing is that technical analysis, chart analysis is one building block. It's not the only way to look at things. But you still need to determine a specific pattern that you look at. Something, there's hundreds of patterns. There's thousands of chart patterns. But you need to decide which ones are relevant for you. Is it really just a chart pattern? Is it a combination of certain things? What the point of that is that when you learn to specialize on a certain pattern in combination with the rest of the building blocks, then you really learn to truly work with the market. You understand the characteristics of your trades much better. Also, sometimes you may enter a trade where all these things line up beautifully, and then it's a much higher probability trade. And sometimes you enter a trade where, only a number of these criteria were met. And then you may find out, how well do I actually perform? How many of my criteria need to be met? Which one is more important than others potentially? But the entry pattern is definitely one of the building blocks that is important to make sure that you have something with consistency, something that you study, that you analyze the details of it. Simple example, if you use a double bottom or a double top, are you measuring the size of the legs? Is there really a difference between them? Is there any repetitiveness in the patterns of these legs in the ratios and relationships to the coming move or to the earlier move? Or, so those could be, ideas to help you get more into the details of your actual pattern that you're looking at, to work with the market again, not to see things that you just see, that you want to see. And that's also why when we have a number of building blocks, we don't, the risk of just, getting romantically involved with one pattern is very low, because it's really not the only thing you look at. It's one of the things that you look at, and this is why it helps you to prevent you again from taking false signals, or reduces the probability of those a lot. The next building block is what we call the time of trading. It's so simple, A lot of you know that there are different trading sessions. There's an Asian trading session, there's a London trading session, there's a New York trading session. But do you actually look at your trades also from a probability perspective, in which of these sessions or in which time of the day you are actually having more success and less success? Because there's a profile to every trading session out there, right? But also, you want to understand that Simple example, if you notice that in the London session, your results are much weaker than in a New York session, or at a certain other time window over the day, then why would you bother look at the London session? Most people, like I said, they're just looking for their pattern, and they trade it any time of the day. And they don't even know if another time of the day has a higher or a lower chance of winning, right? So as you gather the data, as you backtest your trades, as you build your journal, you will be able to look at the time of trading. Is there a pattern? Is there something that you can get out of the data that tells you more reliably which time of the day works better, which time of the day works less good? If you don't find that, you don't need to, create it. No, that's not what we're trying to do. We're not trying to engage in wishful thinking or into any mirages here. On the opposite. But I will tell you that you would be surprised that many times you may have an edge just by choosing a different time of trading or by focusing on a certain session. And a great example, is market open scalpers. That's the reason why they do that, because in the morning when the market's open, banks have all the, let's just say, requirements to trade because of a simple commerce of a market. Like currency markets are not made for trading, like speculation only, but because there's an economy that needs to exchange currencies, right? In order to be able to trade with each other. I don't mean financial trading. I mean like real goods, or services even. So there's a need of currency exchanges. And usually, when the bank has been closed, the next morning the bank opens up, there's a backlog of transactions to process, sometimes more, sometimes less. But this is why morning times have a very different type of profile or session opening times than a later part of a session. So depending on what you are trying to capture with your pattern, with your strategy, 7 building blocks type of thinking, will give you for sure a much better chance to win when you consider the time of trading on top. Very important that you look at that as well. The next is an additional confirmation is another building block. That could be, it could be a volume bar, it could be a reaction to a level, but it also could be the prime market terminal. Maybe it's the order stream that we have. We have there in that tool, where are the institutional positions in the market? Where are the retail positions in the market? Does it make sense to trade in the direction of the retail? Does it make sense to trade in the direction opposing the retails? How do you combine that with the rest of your rules? Is there a statistical, evidence that it makes sense to add this confirmation? Again, this layer of confirmation will do 2 things. It will filter your bad trades, and it will increase your good trades as you make this all in a one coherent application, and so super important that even when all the other things align, do you have another tool, another thing, another way of looking at things in order to additionally confirm what you do? Yes or no? Maybe again, if you are really doing the whole backtesting thing and live trading, and you notice this confirmation, I don't really need it. It doesn't give me any advantage. I can see it in the data that it's not really helping me. Then again, there's no must. The point is that what you must do is first analyze for it in your strategy development process. This is why I'm so keen on this developing process that you need to learn if you want to succeed in trading. So again, it will not only just increase your accuracy, it will also increase your confidence. This is the most important part, because obviously a huge part of trading is psychology. And you cannot, fake it till you make it, guys. This is the most stupidest, thing I heard. You cannot fake confidence if you don't have ability. You need to have skills. You can fake confidence to fake your way into a situation, but if you don't have the skills, you will fail, So you have to build skills. And this is how you build skills, by, developing your own strategy and by looking at it from a multidimensional aspect, and really bring it all together, train the execution, build the data, and this is how you become confident. So another layer of confirmation is one other building block that really, really helps you to succeed there as well. The next building block is obviously risk management. Like, we've all heard about risk management, but what is it exactly? How do you manage your risk? What are your risk management rules? Is it just a simple risk reward ratio? Or do you have more to it? Is it maybe also something that, again, is more works in relations and ratios, or is it something that you do absolute 20 pips, 10 pips, 5 pips, or is it in relationship to a volatility value, or is it just a simple one-on-one? What is it exactly? How do you manage your risk? What are your rules to manage your risk? Have you written them down exactly? Do you know exactly when and how you must decisively act? Because again, if you are not decisive in your risk management action, then it will be too late. Then you will find yourself more often than you want caught up, entangled in a situation that you are afraid of, that you don't know how to get out of again, that you're just hoping to solve itself somehow, right? And that's exactly what we don't want you to be in. That's exactly what we train you for, never to be in again. And this is why risk management is another layer that is extremely important that you understand also and how you apply it. And that's exactly what I teach in my mentorship as well. The next building block is trade management. So how do you deal with your trade when it's open? Maybe you should maybe you should use a trading stop. Maybe you should look at your trade half an hour after you open it always. Is it anything relative to price movement? Is it something that you also always should do in an absolute value again? So trade management, or is it something you should not do? When you mess with your trades, you end up cutting your winners short. But again, as you backtest, as you build the data and answering those questions for hundreds, thousands of trades, you will understand much better, you will know much better from the real data that you created. You trust yourself now for the data that you created. You understand the power in that, and then you will know how you should manage your trades. When, what, how much, or not at all. Like these kind of things, instead of just messing with your trades because I'm afraid, or I'm overconfident, or you know what I mean? Like don't let your emotions dictate how you manage your trade. Let your planning and your testing and your data, give you insights about how you manage your trades. And that will enormously increase your ability to not cut your winners short and to not let your losses run, but the opposite. You will cut your losses short and you will let your winners run a lot better as you understand the real necessities of trade management in your trading, and that will help you so much. So everybody knows what trade management is, but nobody really trains for it. Nobody tests for it. Nobody really develops rules for it. At least not what I see. Maybe I'm overlooking things here. But what do I see a lot more? People messing with their trades, and they were unsure when they did the trade management. They were unsure afterwards. They were unhappy with the result, and this is like this endless spiral of shit, And that's not what we participate in. On the contrary, we create these rules, we create these 7 building blocks so that you can build, consistency, reliability, confidence, and strength from exactly that. And this is why it works. There's no sorcery, no magic thing happening here. But in fact, you are become capable, and that's really the biggest differentiator in my mentorship, I would say, compared to anything else I've seen there. I don't teach you one single strategy. I give you all the necessary skills and I help you with every step along the way so that you can do it yourself and you become confident, you become strong, you become able. And that's really, what I love to see completely. This is, I love these developments, I've literally seen a number of students that started very, very shy and that ended up now being real monsters from their confidence and ability. And the other way around, I had students that were very confident, but needed to be humbled by the reality of their results. But then, because they have, let's just say, maybe more of a talent to be confident, but just because you have a talent of being confident because of all this fake it till you make it culture that we live in, you can be confidently running into margin calls millions of times. How is that helping you, So confidence or fake confidence is actually dangerous, not just unwanted, it's dangerous, and by bringing really, order and structure and data and evidence to these things, and then multiple angles to look at it, and these 7 building blocks, that will help you enormously. So that's my video today. I just want to give you a little bit of a intro into the 7 building blocks. That's what we teach here in my mentorship, among other things. But really, my goal is to teach you to become capable of developing your own trading strategy, because this, as far as I understand, is the only way that you can make it in trading. So thank you very much for listening. If you like what I do here, leave me a like, subscribe, give me a comment, whatever you would like me to talk about. And I look forward to seeing you on the next video. Bye-bye.